Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. One of the big electric vehicle charging companies, EVgo, dropped this week for a number of reasons that I want to go through. This is a company that continues to struggle along with a lot of its other EV charging competitors. So I think investors really need to think about the competitive dynamics here, what sort of valuation we're getting, and what management is really telling us by their actions. My name is Travis Hoyam. Thanks for watching Rive Investing. Please subscribe here on YouTube for all my content. And let's start with the stock chart and exactly what's happened recently. You can see that shares are down 39% in the last month. And if we go to 5 days, down about 6.5% in the last 5 days. So what's the reason for that? Well, the big reason is that on May 17th, the company announced pricing of a massive stock sale, 29.4 million shares on top of 4.4 million if underwriters exercise their 30-day option to purchase more shares, expecting to be about $121 million raised in this round right now. And the company has a market cap of just over $1 billion right now. So this is a massive raise. So why would a company like this need to raise money? And if we go back to results that were reported just a week earlier, this really tells us what we need to know. Revenue growth, just phenomenal, 229% to $25.3 million. But in the EV space, I don't really want to see revenue growth. What I want to see is free cash flow or net income. And if we go down here to the income statement, you can see here gross profit was just $41,000 on $25.3 million in revenue, nowhere near covering the operating costs of $42.6 million. So a lot of growth for this company, but still burning through a lot of money. Move back up here to the balance sheet. You can see that at the end of March, EVgo had $163.5 million in cash on the balance sheet. But now move down here to the statement of cash flows, and you get operating cash loss of $19 million, investing activities, $65 million. So $80 million or so of investment in a single quarter, you're going to run out of that cash pretty quickly. And so that's why the company is raising cash. The challenge for EVgo and a lot of these charging companies is there's really no competitive advantage that they have. They're delivering a commodity, electricity, through a plug that's standardized to vehicles that they don't own. And I just don't see a reason that that gets a high valuation from investors. Frankly, a lot of these companies don't have much of a future if they're going to be standalone operations without finding some way to partner with a bigger company. So I don't know if that means that one of the big automakers buys up a bunch of these companies when they get a little bit lower valuation, or whether you see something like a large gas station owner try to buy up some of these, try to move to the next generation of fueling, which would be electricity instead of gasoline. But right now, as an investor, if I'm looking at EV charging companies, I'm seeing a lot of growth, but I'm seeing losses every single year, every single quarter. And I just don't see an end in sight to that. So this is an area where I would absolutely stay away as an investor. And the fact that EVgo raised as much money as they did last week is just a sign that this company is not going to be sustainable from a financial standpoint. But what did you think about the big capital raise last week? Love to hear your comments in the comments section below. Don't forget to follow Rive Investing. Thanks for watching, everybody. See you here next time.